Ponzi schemes are one of the most dangerous forms of investment fraud that have cost people billions of dollars over the years. These fraudulent schemes promise extraordinary returns with little to no risk, but they're designed to steal your money. In this video, you'll learn exactly how these schemes work, how to recognize the warning signs, and most importantly, how to protect yourself and your hard-earned money from falling victim to this type of fraud. Understanding Ponzi schemes is essential for anyone who invests or plans to invest in the future. A Ponzi scheme is a fraudulent investment operation where the person running the scheme pays returns to earlier investors using money collected from new investors, rather than from actual business profits or legitimate investment gains. Essentially, it's a system where old investors are paid with new investors' money. The scheme is named after Charles Ponzi, an Italian con artist who ran this type of fraud in the 1920s, defrauding thousands of investors out of millions of dollars. The key characteristic is that there's no real underlying business or investment generating profits. It's simply money moving from new victims to earlier victims, with the operator taking a large cut along the way. Ponzi schemes follow a predictable pattern. First, the operator promises incredibly high returns with little or no risk to attract investors. These promises sound too good to be true because they are. Second, new investors put their money into the scheme, believing they're making a legitimate investment. Third, the operator uses money from these new investors to pay returns to earlier investors. This creates the illusion that the investment is actually generating profits, which encourages more people to invest. Finally, the scheme inevitably collapses when the flow of new money slows down or stops. At this point, the operator can no longer pay returns, and the scheme falls apart, leaving most investors with nothing. Ponzi schemes have a pyramid-like structure where different levels of investors experience vastly different outcomes. At the very top is the operator, who takes the majority of the money for themselves. Just below are the early investors, who may actually receive some returns because they're being paid with money from later investors. This makes them believe the investment is legitimate, and they often become unwitting promoters of the scheme. In the middle are investors who receive little to nothing as the scheme begins to struggle. At the bottom are the late investors, who lose everything when the scheme inevitably collapses. The vast majority of participants end up losing their entire investment, while only the operator and a few early investors profit. There are several critical warning signs that can help you identify a potential Ponzi scheme. First, be extremely wary of guaranteed high returns. Any investment that promises unusually high or consistent returns with little to no risk is a major red flag. Legitimate investments always carry some level of risk, and high returns are never guaranteed. Second, watch out for unregistered investments. If an investment isn't registered with financial authorities or regulators, that's a serious concern. Third, be suspicious of secretive strategies. If the promoter gives vague or overly complex explanations about how profits are generated or refuses to provide clear details, that's a warning sign. Finally, pay attention if you have difficulty withdrawing your money. Problems receiving payments or cashing out your investment often indicate the scheme is running out of money and about to collapse. Ponzi scheme operators use several psychological tactics to manipulate potential victims. They rely heavily on social proof, using testimonials from early investors who received payouts to build trust and credibility. They create urgency pressure by offering limited-time opportunities, which prevents you from doing proper research and due diligence. They project fake credibility by fabricating professional credentials, impressive resumes, and maintaining polished, professional appearances. They use exclusivity to make the opportunity seem special, as if you're getting access to a privileged investment that most people can't access. They provide early payouts to initial investors, which creates powerful word-of-mouth marketing and encourages more investment. Finally, they often engage in affinity fraud, targeting specific communities or groups where they can exploit existing trust networks, such as religious communities, ethnic groups, or professional associations. It's crucial to understand the fundamental differences between Ponzi schemes and legitimate investments. Ponzi schemes have no real business activity whatsoever. They pay old investors with new investors' money rather than from actual profits. They guarantee impossibly high returns and operate in secrecy, refusing to provide transparency. They're unregistered with financial authorities, and victims often have difficulty withdrawing their funds. In contrast, legitimate investments involve real products or services that generate actual revenue. Returns come from genuine business profits or asset appreciation. They offer realistic return expectations based on market conditions and clearly communicate that all investments carry risk. Legitimate investments operate with complete transparency, are properly registered and regulated by financial authorities, and allow easy access to your money according to the investment terms. Protecting yourself from Ponzi schemes requires diligence and skepticism. First, research thoroughly before investing any money. Verify the company's registration with financial regulators, check the backgrounds of the people involved, and look for reviews and information from independent, unbiased sources. Second, ask detailed questions about how the investment works. Demand clear, understandable explanations about how profits are generated and exactly where your money will be invested. If you can't get straight answers, walk away. Third, check registration status. Confirm that the investment and the people selling it are properly registered with the appropriate financial regulatory authorities in your country. Fourth, maintain a healthy skepticism. Remember that if an investment opportunity seems too good to be true, it almost certainly is. No legitimate investment can guarantee high returns without risk. History is filled with devastating Ponzi schemes that have destroyed countless lives. Bernie Madoff ran the largest Ponzi scheme in history through his investment firm, operating for nearly 2 decades before it finally collapsed. His scheme defrauded investors of an estimated $65 billion. Alan Stanford sold fraudulent certificates of deposit through an offshore bank, promising impossibly high interest rates. His scheme resulted in losses of approximately $7 billion. Charles Ponzi, the man who gave these schemes their name, originally claimed to be profiting from postal reply coupon arbitrage. He promised investors a 50% return in just 45 days, which resulted in losses of about $20 million in the 1920s, equivalent to hundreds of millions today. More recently, OneCoin was a fake cryptocurrency Ponzi scheme that targeted investors worldwide. The operators disappeared with approximately $4 billion, leaving victims with nothing. These cases demonstrate that Ponzi schemes can operate at any scale and target anyone, from sophisticated investors to everyday people. The most important lesson about Ponzi schemes is this: if an investment opportunity promises guaranteed high returns with no risk, it's almost certainly a Ponzi scheme. Legitimate investments always carry some level of risk, and high returns are never guaranteed. Before investing any money, always verify the investment's legitimacy, conduct thorough research, and consult with independent financial professionals who have no stake in the investment. Stay informed by learning about investment fraud and the warning signs of scams. If you encounter a suspicious investment scheme, speak up and report it to the appropriate authorities to protect others. Finally, always think critically and question any promises that seem too good to be true. Your skepticism could save you from losing your life savings. Remember, protecting your money starts with education and awareness. Stay vigilant, ask questions, and never invest in something you don't fully understand.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.